I want to cover some of the specific points that the Chancellor raised in his budget. The first point I always find interesting is to see where the money actually comes from. Income tax, national insurance contributions, far and away the biggest contributors, a third between them, VAT, corporation tax, fuel duties, and there's others which I shall be coming on to a minute. Bear in mind, corporation tax is not the big contributor. If a company or a business is established in the UK, the government collects far more money in PAYE, national insurance contributions and VAT on expenditure than it does in corporation tax. Corporation tax is a little bit of a sideshow. So if you think the government's losing out on corporation tax from businesses establishing in the UK, bear in mind it's not a big sum of money. The other interesting thing is where the others come from, and you can see here a percentage of the total take. Capital gains tax, £7 billion, 1% of government revenues. Stamp duty land tax, 2% of government revenues. On shares, 0.5%. They're not big sums of money. Inheritance tax, £5 billion. I mean, nearly twice as much money is raised on tobacco tax. If you're a smoker, please don't give up, because if you do, the rest of us will have to pay a lot more tax. Alcohol duties, 11 billion. And other, I mean, that's the dog licenses, fishing permits, landfill tax and all the rest of it. Individually, they add up to a lot of money, but individually, these items are not large. So when you think about the effort and the argument and the controversy that goes into inheritance tax for something that's producing, broadly speaking, 0.5% of the government revenues, it's a rounding difference, really. It's also interesting to see what these things are spent on. Pensions and welfare. A third of government expenditure is what's called transfer payments. That's when the government just gives people money. Then you've got healthcare, education, defence, classically seen as a very big expenditure item, is actually now only 6% of the budget. Slightly less than the government spends on debt interest. Public order, safety, and again there's all the others at 14%. So it's interesting when you look at how much money, where it comes from and what it's spent on. The things that often attract the most publicity and the highest profile in the press aren't necessarily the big important items. This is the other interesting figure. National debt, about £1,600 billion. I mean, it's obviously more than that. It goes up by the minute. But it was that probably 2 or 3 weeks ago. Just think of the effects on inflation. If we have inflation, the government, as a body with net monetary liabilities, is gaining from inflation. 2% inflation reduces the real value of that government debt, or what it was then anyway, by £33 billion. Now, just think about those numbers. £33 billion, that's almost as much as the defence budget. So the classic thing about governments inflating away their debt, it's a huge contributor. A bit of inflation is a huge contributor to the government's finances. Now, just on to a few specific changes here. Capital gains tax, which is something we talked about. The rates are going down. Basic rate taxpayer 18 to 10, higher rate 28 to 20. Entrepreneurs relief remains at 10%, but the rate of capital gains tax on residential property is still going to be the 18% or 28% rates. Clearly, the government's looking to restrict buy-to-lets, people having too many houses or more house than one. You'll see, as we go through this, a number of other provisions looking to restrict buy-to-let housing. Clearly, the government has decided as a policy that if they restrict buy-to-let housing, it will restrict the demand and thus the pricing of housing. Paul earlier mentioned the fact that the high-end property transactions in London are significantly down. They are down. That it is partly less revenue, but I suspect it's also the government, you could say a successful government policy perhaps, in restricting the demand for these houses, which is all properties, which is pushing the price down and perhaps making them more affordable to the natives. There's going to be new entrepreneurs relief, 10% rate of tax on shares in private companies that are subscribed for, that are held for at least 3 years and issued after the 17th of March. You don't need to be a director and you don't need to hold more than 5%. And there's going to be a £10 million lifetime limit. And there'll be a number of conditions to follow, and at the moment we don't know what they are. I can probably guess what a lot of them are. It's probably got to be a trading company and not involved in certain type of businesses. Anybody who's looked at the EIS relief rules can probably guess what's coming on that front. But entrepreneurs relief on selling your goodwill is going to be backdated, but it looks like it only works if you own less than 5% of the buyer. So for those of you for whom this is relevant, this was a very useful relief in transferring the goodwill of business to a company that you controlled. Partnership interests. This is particularly interesting to what is called hybrid partnerships. A number of things like solicitors, for example, you find the solicitor's practice is carried on by an LLP, but the individuals hold their partnership interests through a company. The original proposal meant that interest in a partnership didn't qualify for entrepreneurs relief. They're now changing the rule back again so that they will, provided that the individual has an effective 5% interest in the partnership. This is quite welcome to a number of people. As I said, solicitors are a classic example, where the solicitor's firm traded through an LLP, but a number of the members held their interests through a company. After 6th of April 2016, if you liquidate a company and within 2 years you are involved in a similar trade as a sole trader or through a company in which you or a connected person holds shares, and you do it for tax avoidance purpose, then the liquidation proceeds are retrospectively taxed as income. The classic contractor would provide his services through a company, allow the income to roll up in the company. He might get a job, so he'd become an employee for 6 to 12 months. He doesn't need the company, he'd then liquidate the company. He'd then give up that job, go back as a contractor, start another company, do the same thing again. That is something that is being specifically targeted, and said contractor will be subject to income tax on his liquidation dividends. We have been corresponding with the revenue on this, particularly in the case of, for example, special purpose property companies. A lot of property transactions are undertaken through special purpose companies. You don't need the company after you've done the transaction, so you want to wind it up. We raised this with the guy at the Revenue who's responsible for this legislation, and he said, yes, it's a very good point, he said. It's a difficult issue, he said. We are still considering it, and we are looking at ways to address that properly. So they haven't really got their heads around that particular one yet. When the Chancellor was elected, shortly afterwards, he said that he was not going to increase the rates of income tax or national insurance contributions. There's a little bit of fiddling going on here, because whilst he hasn't necessarily increased the rates of tax, he has a little bit on tax on dividends, what he has done is to abolish the tax credits. So the effective rate of tax that you pay on dividends that you receive has actually gone up quite substantially. If you're a basic rate taxpayer, paying tax at 20%, you go from 0 to 7.5%, 40% band from 25 to 32, and the additional rate from 30 to 38%. You do get a £5,000 allowance, but it's quite a significant increase in the tax rate. And unfortunately, at the moment, it's a bit of a grin and bear it, because if you are in a position to control the money that you get from a company, if you control the company, you're still better off taking a dividend than a bonus. Not quite so much better off, but nevertheless, unfortunately, there's not really a great deal that you can do about it at the moment. One thing you can do, of course, is to do a little bit of planning for your dividends, and to the extent that you can control the dividends that you receive from a company, you're clearly better off getting them this year instead of next year, if they will be taxed at a higher rate next year than this year. So if you do control a company and you are you would receive dividends next year, is it worth you getting them this year? If so, make sure that you properly minute them and pay them before the end of the year. As I'm sure a lot of you are aware, a lot of people provide services through a company because they are effectively short-term employees. The Revenue has some legislation which is colloquially referred to as IR35. It's actually the legislation section 48 onwards of the Income Tax, Employment and Pensions Act 2003, for those of you who want to look it up. What this does is it seeks to tax people who provide their services through a company but who would otherwise be employees. They've collected very little money under this legislation. They're not very good at enforcing it. When they have tried to enforce it and taken cases to court, they have a habit of losing more cases than they win. So they've been particularly unsuccessful. But one particular target that they're aiming at is contractors who provide their services to the public sector. What they are proposing to do is to move the obligation to deduct PAYE to the public service customer. We don't have the details yet, so we're not quite sure how to achieve this. But of course, inevitably, what will probably happen is the public service customer will overreact and simply deduct the tax if they think there's the slightest doubt that they might be caught by these provisions, whether the contractor's within it or not. So we could have some interesting arguments there about people whose tax is being over-deducted and difficulty reclaiming it. But we'll see what happens, and in particular we'll have to see what the detailed legislation says. Over the past few years, a number of employers have set up something called an employee benefit trust scheme. What happens is the company makes a contribution to the employee benefit trust, on which it claimed tax relief, and the employee benefit trust then lent the money to the employee. The employee had a tax charge on the deemed interest each year, but no other tax liability. The current proposal is that if any of those loans are still outstanding in 2019, the Revenue will be collecting the tax on the loan. Now, as I said, if it doesn't affect you, it's probably a bit academic. If it does affect you, this is potentially a big item, because I know people who have £1-2 million or more borrowed from these employee benefit trusts. They spent the money and they're sitting there, potentially sitting there with a very large income tax bill. What we're not quite sure on, of course, is who's going to be paying the tax, because what the Revenue like to do is to assess the company that paid the tax to PAYE. A lot of those companies aren't there anymore. A lot of them have been wound up. So there might be an interesting question about actually collecting that money. When Dominic was here, we talked a bit about pensions. As somebody said, there was rumours I'll come back to a rumour. There were rumours in the press about the whole system changing. There had been rumours in the newspapers for 12 to 18 months about the system changing. Bear in mind, of course, a lot of those rumours are actually put out by the government to encourage debate and to see what people's reaction on these things are, so to see how much clamouring there is. The numbers here are interesting, though. Pension tax relief costs the government about £34 billion each year. The tax on pensions is about £13 billion. So the net loss to the government on the tax relief on pensions is the difference between those two. It's quite a big number. I think £21 billion. Just think back to those numbers I showed you at the start. Defence budget, £46 billion. Right? So in the context of government money, it's quite a big sum of money. At the moment, the arrangement we have in this country is you get relief for the contributions, there's tax-free income in the fund, and you pay tax on the pension when you get it out. Nice and simple. Tax relief in, tax on the way out. The favourite alternative system, which is used in other countries, is you don't get any relief when you put the contributions in. The money in the fund is tax-free, and there's no tax on the pension when it's paid out, as you would expect. A sort of super ISA type of arrangement. And that's the possible, the obvious alternative. There have been other alternatives talked about where the government gives a flat, people make personal contributions to a pension fund and the government puts in 25% of the amount. That's been said to be beneficial to lower paid employees. Well, of course, if you think about it, if an employee, imagine a company makes a pension contribution on behalf of a basic rate taxpayer, puts £100 in. Imagine the employee puts the £100 in, the government pays 25%. Ignoring the income tax, the 25% is only the extra national insurance contribution the government's getting because the individual's been paid the money instead of it going into the pension fund. So it's not actually costing the government anything. But nevertheless, when it was in the press, that looked like quite a good bargain. That's another possibility. Now, the problem you have, of course, is if you wanted to change from one system to the other. It's quite simple for a defined benefit system, a bit more difficult for a final salary scheme, also a bit more complicated for public sector because it doesn't actually have a pension fund. You also got two systems if you wanted to switch from one to the other. On the one hand, people have had relief for paying contributions to the old scheme, so you'd want to collect tax on the payments out of those, and only the new fund schemes would come out tax-free. There's a little bit of an earning opportunity here. At the moment, you tax the payouts from people's old scheme. What if you said to them, you've got £200,000, £300,000 in your old style pension scheme, give me 10% or 15% and I'll convert it to a new scheme so you can take the money out tax-free. From the government's point of view, of course, it's a huge amount of money coming into the public coffers in 1 year. Okay, that reduces their tax take in the future years, but then that's the next government's problem. So that's, you don't think that far ahead. So quite a useful little earner for the government, actually, if you think about it. Pension contributions and funds are already being severely restricted. When this pension pot legislation came in, there's a limit on the size of the pension fund you can have. It was £1.75 million. It's now coming down to £1 million. In real terms, that's £750,000. So the size of the pot that you can have in real terms has already come down by significantly over 50%. So there's already a substantial reduction in the amount of relief given for pensions over the last 10 years. Limits on contributions as well. We've now got a £40,000 annual limit which can be carried forward for up to 3 years. If your income's over £150,000, including pension contributions, there's a restriction of £1 for every £2. Once you're up to £210,000, contribution limits are £10,000. I see quite a few large pensions coming through from clients who we act for, and you often think to yourself, well, in a few years' time, we're never going to see a pension like that again because the size of the pot that you would need to produce quite chunky pensions is actually huge. I mean, far in excess of the £1 million that we have now. However, if you do have money in a pension fund and you can afford to, the best thing to do is to leave it there, because money in a pension fund is inheritance tax free. When you die, your heirs can take the money out, subject only to paying income tax at the time. If you have a pension fund that you can effectively control, you're far better to spend your capital and leave your money in your pension fund, where it will remain IHT free. You remember I talked to you about the possibility of an ISA, some sort of super ISA replacing a pension fund. Well, I wonder if the Chancellor's sort of going in that direction in tiny steps. He's now introduced the ISA limit to £20,000, and if you're under 40, if you save £4,000, the government puts in another £1,000. So you think about it, pensions coming down, ISA's going up. So is he actually going in that direction step by step? Possibly. Buy-to-let landlords, as I mentioned earlier, seem to be a big target for Chancellor throttling back. He's charged an extra 3% stamp duty land tax on properties. If you own a property and you buy another one, there's an SDLT surcharge of 3%. If you're moving from one property to another, current proposal is you pay the extra 3%, and if you sell the first house within 3 years, you get the 3% back. Tax relief is being restricted in stages to tax relief only at the basic rate. If you are a serious landlord, or if you're looking to go into business as a serious landlord, much more interest now in doing so through a company. The rate of tax on profits is only will be 17%. That includes capital gains, and you get indexation allowance. On building up a portfolio, it's much more tax efficient to do it in a company. Disadvantage, of course, is that first you've got 2 lots of tax to get the money out, and secondly, the loan deals on buy-to-let loans to a company are generally speaking a lot less favourable than what they are on loans to an individual. For those of you who are not domiciled in the UK or who have a friend who isn't, this makes potentially a big difference to you. From 2017, you're deemed domicile after 15 years of residence. That applies for inheritance tax, capital gains tax and income tax, but not for the purposes of general law. There are various general legal matters that are affected by your domicile, things like in wills and that sort of thing, and probate. They are not affected. It also doesn't affect a trust that a non-domiciled person settles before he is deemed to be domiciled, unless he is what is called a returning domicile. Of course, these domicile rules have inspired a lot of people to review their residence status. We now have a statutory residence rule set out in FA 2013. So you can now step through the rules and see whether or not you are resident in the UK, which used to be very difficult in the past. If you've got 3 houses, it's relatively, and you're prepared to split your time between the 3 of them, it's relatively easy not to be resident anywhere. There is no rule that says you have to be resident anywhere for tax purposes, just as there is no rule that says you can only be you are only resident in one country for tax purposes. So judicious spreading of your time between 3 properties, you can relatively easily not be resident anywhere. And of course, if you are a non-dom, then you've got yet more hassle, the ATED limit. ATED stands for Annual Tax on Enveloped Dwellings. A catchy little number, isn't it? It applies to houses, residential houses that are owned by companies and occupied by somebody connected with the company. The reason why this primarily applies to non-doms is that people who are not resident or not domiciled in the UK would traditionally buy a UK house through an offshore company so that they did not have to pay inheritance tax if they were to die while they owned it, and there were a number of other advantages. The government used to argue that they were doing this to avoid stamp duty, and they could transfer the shares in the property stamp duty free. I don't think that's really the primary reason. In my experience, the main protection was the inheritance tax, the asset protection, and the confidentiality. Anyway, a couple of years ago, they introduced something called the annual tax on enveloped dwellings. It started down, I think it was at £2 million. If your house was £2 million, the tax was £15,000. If the house was worth £5 million, it's £35,000, and so on. Those ATED limits have now come down. From next year, if it's worth more than £500,000, there's an ATED, and it's occupied by a connected person, there's an ATED charge, and it only seems to go one way. They're also proposing to look through offshore companies for inheritance tax purposes. So if you parked your house in an offshore company, they're looking to collect inheritance tax. Haven't yet seen detailed legislation for that. We are already seeing, however, a difference in the way that non-doms are structuring their house purchases. Now a lot of them are buying the houses personally and charging it against a zero coupon bond from a connected company. so that the value of although they own the house personally, the value of it for inheritance tax purposes, less the debt, is nil. And of course, the interest, the coupon on the zero ticks up each year, hopefully faster than keep pace the house price. So that's becoming popular. Well, popular for a client of ours anyway. CGT on 8 properties from the 6th of April 2015. CGT on all residential properties. This is residential only, not commercial. Owned by non-residents from the 6th of April 2016. But the gains are rebased. And this was another little thing he slipped in. Tax on non-UK developers. If you're not based in the UK, you can develop a property in the UK and not pay tax on the development profits. Popular amongst these were structures based in Jersey, Guernsey or the Isle of Man, which have very old double tax treaties which do not carve out real property profits. So they protect profits on real property transactions. Those are the sorts of structures he's targeting. He's looking to collect corporation tax on the profits of UK property. I suspect that if you look behind the owner of something like the Battersea Power Station site, you'd probably find a company in Jersey, Guernsey or the Isle of Man. And you probably find somebody who's hoping not to pay tax on the profit he made on the development. And these provisions are aimed at that. Whether there will be a profit on that development on which to avoid tax, of course, remains to be seen, given the way central London prices are moving. But nevertheless, that's what he's aiming at. The other thing that's under attack is large companies. You will have seen a lot of publicity, Google, Starbucks, all this sort of thing, attacking large companies not paying their fair share of tax. Bear in mind what I said earlier, that corporation tax is not that big a number. The PAY, the national insurance, the VAT on a company establishing in the UK is much, much more than the corporation tax. Nevertheless, government obviously feels it needs to do something. So, nice little concession. After 1st of April 17, you can offset losses against your total profits. But if your profits are more than 5 million, you can only cover half of your profits with losses, or 25% if you're a bank. Limit on tax relief for interest. Current proposal is that interest deduction is limited to 30% of your profits. Now, that may not be such an issue, but we have a number of clients who are active in infrastructure funding and PFI projects. These are typically funded by very small equity and 99% debt. There's going to be an interesting issue here because, of course, those companies do have very large debt charges. And indeed, if they don't get tax relief for it, then they will go bust because they are set up on that basis. There was talk in the original proposals about some sort of relief for companies involved in infrastructure projects. And so we'll have to see how that goes. But that potentially makes a big difference to a large number of PFI projects. And so we have several clients who are active in that area. Royalties, withholding tax, they're going to extend withholding tax to cover all IP royalties and tighten up anti-abuse rules. You will remember how Starbucks used to pay a 5% license fee for the use of the Starbucks name to a company in the Netherlands on which it used to claim tax relief and which never used to get taxed. Well, this provision is clearly aimed at that sort of thing. Bearing in mind withholding tax is 20%, and if corporation tax is 17%, the withholding tax is actually going to be more than the corporation tax relief you're getting. A bit of royalty restructuring may be necessary there. That's all I have to say. Thank you.